Okay, looks like we are in. Hi everybody, welcome to UPSC Buffet and let's start today's session. So last day we have discussed 2023 economy questions. Today we'll be discussing the 2024 ones. And like I have said earlier, 2023 was kind of a outlier or a standard deviation from the normal pattern that we used to have in all subjects including economy. But we could get some conceptual questions from there, and most of the questions they have asked, like the beta, what does that stands for, etc., are like an outlier sort of question which you needed some sort of logic. But on the other hand, in 2024 the question has taken a slightly different state of tune, because the options has been reduced from this only one only two format to normal 1 2 3 type, which makes elimination possible. But at the same time, the kind of questions we had in economy in particular was that the questions were more factual in nature and more current affair oriented. But that's not the case in 2025. So 2024 is again a slight deviation in terms of the content of the question that has been asked. So keep that in mind, okay? Just have an idea about the kind of questions that are being asked every year. 2023 complete outlier, but 2024 more factual, current affair oriented. But going through the PYQs is actually enough for you to attend the 2025, because an amalgamation of all those questions in the last 5 to 6 years has been asked in 2025, which actually reiterates the importance of PYQs. So without any further ado, we'll get started. So let's start our Indian economy 2024 question discussion. So first one, it's like, in India, which of the following can trade in corporate bonds and government securities? This question outright is factual in nature, as in there is very little logic and concept you could apply, but we could do something about it, okay? Not that we are completely out of hope in this question, but there are few things we could do. But to arrive at the actual answer, you need to have some level of actual knowledge and current affair awareness. First of all, about corporate bonds, we might think that, okay, corporate bonds basically they are most likely debt instruments issued by corporates, and so insurance companies can invest in that, as in can get those bonds or those investments. They can make such investments. Pension funds, obviously. I hope you all know the basic functions of these companies. As in insurance companies, they actually take the money from the customers like premium, and they invest it in business. They're basically investing that money so as to raise funds or to make profit out of it, and that's how they function, okay? So any company, most companies will have their own set of investments apart from their general day-to-day operations. Most of them will have their investments. This includes pension funds as well. So if people are investing their money in pension funds, the fund manager or the company that manages the fund will invest that money somewhere else and make a profit out of it, and obviously will give the pension holder the benefits as per the conditions of that particular pension fund. Retail investors are like normal people, as in they are not institutional investors, big firms or anything. They are just like normal individuals who are investing. That could range from normal people who are just buying single stocks to people who are trading in millions. So that could mean anybody. But retail investor is different from a normal institutional investor, because it's just mostly it's an individual, and it's on a very individualistic level. So have an idea about these retail investors, pension funds and insurance companies. So corporate bonds. There are two parts to this question. Which of the following can trade in corporate bonds and government securities? So we need to have an idea about both, and who all can invest in both of these. Corporate bonds, anybody can actually invest. That's the basic idea. Company needs money and they don't really care who gives them the money. So basically anybody can do that. So these three are part of corporate bonds. So that's there. Government securities is slightly tricky, because insurance companies can invest. Pension funds also can invest, because government actually raises money through that sort. But it has only been open to the retail investors recently. That's the key. This is where the current affair part of the question really comes into the picture. Because if you have a basic idea, you could arrive at the answer as in 1, 2 and 1, 2, 3. You can eliminate 2. A 50-50 can be reached. But the issue is, you need to have an idea about that recently government securities has been open to retail investors like you and me. We could invest in government securities by having a gilt account, and just our existing demat account can be used to invest in government securities. That's the thing, and that particular scheme is called RBI's Retail Direct Scheme. So this is a recent scheme actually. I don't remember exactly when this was released, but it's 2-3 years only. And in normal NSC, BSc, or they can actually provide a separate platform for dealing with these things. Similar question has been asked, I think, in 23 or something. Those stock exchanges could provide a separate platform for trading. So that's slightly connected to this, but you need to have the exact idea that retail direct scheme is what facilitates the investment of retail investors in government securities. So a 50-50 could be reached without any current knowledge and general understanding, but this particular fact you need to know. And there are few questions that you need to have particular fact awareness in this 2024, but don't worry about them too much. Just learn those facts and also try to pay attention to those questions or areas similar to these. Any new schemes where opening of new investment avenues are open for retailers or any other bodies or foreign investment. If anything that's of that sort is been newly introduced in the last 2 years, anything you come across in current affairs or anything, pay attention to that and try to note it down, because they're strictly factual in nature and we cannot actually make a guess or eliminate or use our logic in that matter. So that's about it. The answer to this is D only. Everybody can actually invest, especially under the recent RBI retail direct scheme. Retail investors can invest in government securities. Corporate bond, there is no confusion, but government securities is what is raising slight confusion. If I remember correctly, even the keys that has released post 2024 across the in coaching institutes, they have had a variation, and only UPSC key has given us the D as the answer. So that's it. Moving on, next question. Okay. This is a fairly direct question. You need to have basic understanding. Like I said, yesterday also we were dealing with something like capital investment, capital receipt, those kind of things. These are basics of economy, and you will be dealing with them in NCRTs or your standard books or the PCM courses or whatever you are doing for economy. These are the basic things that you will be reading. There is no higher level understanding needed for any of these. So which of the above are considered as financial instruments? So financial instruments, by the term itself, meaning that's used in the finance domain, okay, meaning that they hold a value in the domain of finance. That's the basic understanding from the word itself. If you don't know about it, like it's like a instrument or a tool that is being used in the financial domain. So exchange traded funds, obviously it's entirely finance. It doesn't really make any sense outside the finance or financial instrument or the finance domain. Motor vehicles, they're actually physical assets, so they may have any financial value, and since they hold a value, they may have a financial value, but we cannot say that they are financial instruments. They are physical assets only, so we can eliminate two. And currencies are obviously a financial instrument, so we'll arrive at the answer. Nothing more is needed. You don't need to overthink about this. Some people might think that motor vehicles, since they hold a value, and we are hypothecating when they are buying a motor vehicle on EMIs, but those are not relevant here. Basically asking financial instruments, things that are having only application in the finance domain. Motor vehicles are a physical asset, so that's a different story. So we'll arrive at the answer as D. So that's it. Moving on, next question. I've slightly made a definition just in case you wanted to refer. Financial instruments are documents or contracts. See, this is the textbook definition, but you don't always need to refer or remember the textbook definition. What I understand is that financial instruments are the things that are actually having relevance in the finance domain, outside of which they don't make much sense. Okay, like physical gold have actual value in finance domain and outside, but financial instruments like a bond, it's like a piece of paper only. Outside the financial domain, it doesn't hold any value. Okay, so it's like investment, borrowing, lending, all sorts of financial activity, facilitating these financial activities, and their contracts or documents. Basically, that's it. Those are financial instruments, and these are the general instruments. Okay, you need to have an idea about these. I've used this question to deliver some content on this matter, because some people might have a doubt regarding what's debt instrument and an equity instrument. If a company is borrowing money, as in from anybody, including retailers, and they're borrowing money as a debt instrument, meaning that they'll be giving an promise, or they are giving a promise that they will pay back the money with such interest rate or annual interest rate or any arrangement that could be there, but they will be paying that money in return. But in terms of equity instruments, if I, for example, if I can invest in Reliance, Radhani, or maybe Meta, anywhere, if I'm investing in that, the investor, the company is getting the money, but in return they are giving me a share of that company, share of ownership of that company. That's called equity instruments. So debt instruments pay back the money with interest or premium, whatever the arrangement is. Equity instruments, they don't pay back anything, they just give you the ownership in a company, but they do give you dividends, things like that. Then money market instruments. Yesterday also we have learned that money market and capital market. Short-term borrowings less than 1 year includes treasury bills, cash management bills, things like that. So these are the basic things of money market. Then derivatives, options, futures. I hope you understand what are derivatives. Derivatives meaning they're derived from something. So basically they will be deriving their value from any other asset or index for that matter. Options trading for NSE based index, Nifty 50, etc. are there. Those are derivative instruments. Just have an idea about that. Okay, mainly you need to understand what are debt instruments and equity instruments. That's the basic thing. Then money market, obviously you know that. Then these masala bonds, green bonds, etc. are the modern instruments. That's basic knowledge. Nothing you need to learn or anything. Just learn about debt and equity instruments. That's it. And what are the differences between both. I've given the example, so this is more than enough. Moving on, next one. Again a basic question, but slightly on a trickier side, because you could have some sort of confusion, especially the way the question is being framed and this only one, only two is given. You need to go through every question, mark it, then count it, and finally mark the answer. Because even I don't know if that's the case with everybody, but for me, this only one, only two question, especially combination of 4 questions are being given. I tend to mark it and I tend to forget it. Even if I have the, I know the answer, but try to do it, like tick it and then count it. That's a silly thing, but that's a kind of mistake everybody makes. So don't make that mistake. Try to mark it in the question paper itself. Okay. So don't shy away from doing that. Storage of agricultural produce. Okay. This is basically storage of produce. Okay. We need to know whether it's secondary or not. Okay. Dairy farming. It's primary, obviously. Mineral exploration. It's definitely primary. It's not secondary. Tertiary. Okay, tertiary activities are service sector. Weaving of cloth, it's secondary. That's true. So the answer is this is primary, this is wrong, and weaving of cloth secondary. So you know what's primary sector. Primary sector means we use the raw material, we extract the raw materials, so we create the raw materials based on the available resources. This could mean agriculture, animal husbandry, and mining. Of course, we are extracting minerals. That's the primary activities. Then secondary activities are the products of these primary activities are being transformed into high value products, or value addition takes place, or the processing of these products takes place. For example, weaving of cloth. We make cloth as in cotton or silk as a primary sector, and the output of that is being used as a raw material for the secondary sector. Tertiary sector means the service sector, where actual exchange of services takes place. Cab, like any service that include cab services or providing assistance or all sort of services. So then there is quaternary sector and quinary sector. I have made a chart of that, so you can actually refer to it and make a good understanding about it. This is primary sector, extract raw material from nature, like I said. Farming, mining, fishing and forestry. Sometimes we tend to confuse it, because mining has been a slightly confusing topic for some people. They might think that okay, this is a secondary sector, but actually mining in its basic form is extraction of minerals from the earth, okay, or from we are directly extracting it. So that's similar to farming, okay, so that's very similar, but processing of minerals is a different story. Just mining is different, and processing or steel production is secondary sector, but mining is primary sector, so that's different. Just pay attention to that. Then secondary sector, textile mills, cement factories, house construction, obviously these banks, hospitals, shops, this is a tertiary sector. And other one, quaternary sector, basically that's knowledge driven services, research and development, things like that. So companies with research development, those sort of things are happening. That's in the quaternary sector. And quinary sector is the highest level of decision making, like world leaders, decision makers, chairpersons of banks, things like that, top government officers, think tanks, CEOs. Those are all the quinary sector. Quaternary sector, research and development. Quinary sector, the highest level decision making. So that's all you need to know. Question could be asked. So just refer to this table. I don't think anything more is needed. Anything more is needed to or any understanding from this particular topic. See, such as basic question has been asked, and see, this is also another one. Financial instrument, sectors. These are like NCRT, basic NCRT questions. So don't underestimate the NCRT and try to build your conceptual clarity from there itself. Okay, don't overlook it. Again, similar basic question. Yeah. With reference to physical capital in Indian economy, consider the following statements, following pairs. Okay, physical capital. So farmer's plow, it's a working capital. Okay, if you go by the or word meaning, you might think that okay, farmer's plow is doing a work, so it's a working capital. No, it's not the case. You need to know that working capital is something that get used up during the process of production. So that could mean fuel, raw materials, inventory, etc. Inventory as in the raw materials. So anything that get used up or is added to the production process is called a working capital. But something that is not used up, like a machinery that is fixed, is called a fixed capital. So that's the basic difference. Something that get used up like fuel, raw materials are all working capital, while the things that are there, for example, the vehicle, the fuel is a working capital, but a vehicle like a tractor is been used, that's a fixed capital. So that's the thing. A computer is a fixed capital. Yarn used by the weaver is not a fixed capital because it gets used up. It's a working capital. So this is wrong. Farmer's plow is a fixed capital. Then petrol is a working capital. Yeah. So only two. So that's the basic thing. And there is another social capital. This is the question about physical capital. And then there are social capital. Similar question also has been asked in 2022, if I remember correctly. Tangible and intangible assets. These are all basic questions. And the same idea of tangible asset is been reworked and repurposed and asked us in 2024 as this question. So this is how having an idea about the PYQs really helps you in understanding or not miss out on topics, or to ensure that there is whole coverage of topics happening. So I've made a list again. So physical are the ones that we can touch, feel. They are tangible ones. Human assets or human capital are the things that we cannot touch or feel. They are ideas, training, education, things like that. Okay, but they do create an impact, but we cannot see. They are all abstract things. So fixed capital, long-term assets, building, equipments, machinery, etc. Working capital, operational, inventory, cash, fuel, raw material, etc. Social capital. This exact question has been asked in 2020, if I remember correctly. It's the basic level of trust or the network or social connect that is being there in the society. This is really helpful in your GS answers, especially in GS1. You could say society answers. Also, this has got an economical output also. In GS3 also you can quote schemes like in border areas, building social capital. Such terms actually elevate your answer. So social capital is also relevant there, and UPSC has been asking similar questions in the past. You can expect such questions. So don't be lost when social capital or something about that is being asked. Don't be surprised. These are the basic things. I think you need to know what's fixed capital and working capital. Okay, working capital is that's one get that used up in the process. Basically cash, fuel, raw material. That's it. Fixed ones are like there. If a computer is being used for that process, it stays that way. Of course, there is depreciation of the assets over long term, or wear and tear will happen, not in case of computer, but other equipments. But they are all fixed assets only, fixed capital. Then the next one. So, with reference to the rules imposed by the Reserve Bank of India while treating foreign banks, consider the following statements. This is a current affair actually, but you can apply some logic and take a calculated guess on this matter. So there has been some question has been about Reserve Bank rules on treating foreign banks. Okay, there is no minimum capital requirement for a wholly owned banking subsidiary in India. For example, if Citibank or any other banks like JP Morgan opens a subsidiary in India, and there is no minimum capital requirement for them. That's what this statement is saying. If you have a basic idea, you know that there obviously will be stringent criteria. There will be capital requirements, minimum capital. A lot of requirements will be there, especially in a banking sector, and we are giving clearance for a foreign bank to operate in India. There will be a whole lot of criteria. So this seems outright improbable or outright impractical. Even for payment banks, small finance banks, we are having strict criteria about minimum capital requirement. So how can we, just give some very lenient stance for foreign banks? That seems very improbable. So this is wrong. For a wholly owned banking subsidiary in India, at least 50% of the board members should be Indian nationals. This is another issue. We might think, in first instance, we might think that, okay, 50% of the board members should be Indian nationals. Kind of makes sense, because we are obviously for domestication or nationalization, as in integration of the foreign entity towards towards our national economy, and while preserving our national interest. This seems very probable, but this is an extreme thing to do, because how can we say that 50% of the board members should be Indian nationals? We can prescribe some criteria, but 50% seems like a big number. But this is a slight risk involved, because this is something that's not improbable, it's probable, but this seems like little far-fetched. So you could eliminate this, and you can arrive at either this 50-50 you can arrive, and if you go by that, you read that thing multiple times, you will get to know that, okay, 50% seems slightly impractical to implement. This can drive away foreign investment, especially in the banking sector, because such a mandate can cause restrictive, that can be restrictive in nature, very unlike this minimum capital requirement, because that's basic for any banks. But this thing could be slightly restrictive. So we can eliminate that and arrive at the answer as D. So this is wrong, and answer is D. So that's it, 49D. Moving on, next question. There's not much you can actually learn from, there is no much takeaway for these questions. These are basically current affairs and just general logic. First statement is pure general understanding. Second one, a slight risk should be taken, because 50% prescription of board members is slightly on the impractical side. What I am saying is based on my intuition, and this intuition I have got from the PYQs itself and the experience. So don't think that whatever I'm saying, or you just have to just buy it. Okay, you just have to feel it. What I'm saying is, you have to, whenever something like 50%, 75% is coming, you need to run it through on the practical scale, and you need to develop an intuition in such a way that you could lean towards eliminating it or taking it. So that's all I'm saying. So this is wrong, answer is D. Moving on, next question, CSR. CSR, I think most of you will be knowing what is CSR. That's corporate social responsibility, and this is basically guidelines of companies on providing social responsible actions like investment in education. A share of their profit needs to be going towards empowerment of the society, empowerment or development of the society. That includes environment protection also. Basically ESG governance, environmental social governance. So that's CSR, and it's mandatory under Companies Act 2013. So that's the basic thing you need to know. Okay. So CSR rules specify that expenditure that benefit the company directly or its employees will not be considered a CSR act. This makes perfect sense, because if a company, this action should be directly beneficial to the society, and it shouldn't be a profit making activity for the company. That makes sense, because the basic idea of corporate social responsibility is to provide, or is to share the resources or share the benefits arising out of a social wealth towards the people itself. That's basically DPSP, sharing the benefits arising out of common good. So that's the basic idea. The corporates are making their profit from the people itself. So, and there is a social and environmental cost to that. So the government or the through legislation, we are mandating that such benefits arising out of it should be given back to the society, not the entirety, but a percentage or a share of it needs to be given back to the society. So such activities should not be profit making, or if it should not be benefiting company directly. Of course, they can market it and can develop a goodwill, but if it's directly benefiting them or doing something that directly benefits them, for example, if a company who sells salt maybe, and they are giving the salt with all the brandings, and they are doing something in a way that benefits them directly, as in they are getting the customers, or they are raising their customer value, things like that, that directly benefits them. It's not a good thing. It's not a good thing as in it's not morally correct, and within this ambit it's not permitted. This is wrong. CSR rules don't specify minimum spending. Of course, it doesn't specify maximum limit, but it does specify minimum limits. Otherwise, companies could go away with any sort of minimum levels. In order for the CSR rules to actually work, there should be a minimum spending. So that is wrong. So this is right. This is wrong. So the answer is 1 only. We'll go slightly into the details of CSR, so you can know it better. So CSR basically must spend a part of their profits on activities that help society. This include education, health, environment, rural development. Not limited to this, of course. Basically education, health, environment, and rural development. And this is mandatory. Okay, there is no other way around CSR if the company falls within the prescribed limits of CSR. So it's governed by Companies Act, Section 135. This is important. Section 135 of Companies Act. Question could be asked in a multiple statement question. A statement could be this, and you need to be knowing that. So CSR, this is the criteria. If a company falls into these categories, they need to be abiding by the CSR rules. So a net worth of 500 crore or more, or, so that's the or condition. That's not and. Okay, again remember, a company need not have all of these. If they strike any of these criteria, they fall within the ambit of CSR. That's the important thing. Okay, they should be having a net worth of 500 crore or a turnover of 1000 crore or net profit of 5 crore or more in any one of the previous financial year. Again important, any one of the previous financial year. That's again important. It's an or condition. Remember that it's not and. They don't need to satisfy 3 of these. They just have to satisfy any one of these. And this is the criteria. Must spend. This is the minimum limit. 2% of average net profit of last 3 years. That's the key thing. 2% of net profit of last 3 years. Not turnover, not net worth, net profit. 2% of net profit of the last 3 years. If a company fails to spend, it actually should be explaining the reason. There will be a penalty provision for that also. So this is basic activities. From the wordings itself, you might have gotten that the kind of activities that could be permitted under CSR: education, poverty alleviation, gender equality, healthcare, environmental protection, rural development. And again, this thing is also CSR. This has been slightly controversial, considering that PM National Relief Fund contribution to PM National Relief Fund is being taken as CSR. There could be an element of quid pro quo between the corporates contributing to the NRF fund. So things like that are there. That has been slightly on the controversial front, but just keep an eye on this. This is approved under CSR. Again, this is also important. Protection of national heritage. This also falls under CSR. Okay, you might have seen that multiple corporates, doing their walkways, railway bridges, things like that. And they might have advertised. This includes SBI, SBI, Federal Bank. Most of the banks, Infosys, companies like Infosys have been doing that. So you might have seen that. Those activities are actually their CSR activities. Walkways, then they do the street lighting, things like that, or payment of curbs, roadside curbs, things like that are there. So that's it. So company can implement through directly company itself, registered trust, registered society. So they don't need to be doing it by themselves. They can actually do it through another registered trust, or Section 8 companies are not-profit companies, NGOs. So registered society, they can do that. So if they are planning to outsource some towards an external agency, they need to have a 3-year track record. That's an important thing. So because companies can actually do this, they can contribute to another shell company that's basically connected to them. So they can abide by the CSR rules. So that's a definite loophole arriving there. That's why this provision has been added, a 3-year track record for external agencies, so that the government can ensure that that's not a shell company. So that's their administrative overhead, as in 5% of the CSR expenditure can be used. Again, this is another thing. For example, if too much expenditure on administration is like a loophole when it comes to economic terms, because if they are spending too much money on administration and not the actual work, this could mean that they have been siphoning the money in the name of administrative cost. So that's the thing. Any surplus amount from CSR activities cannot be taken as profit. That's the thing. It should be reinvested in CSR projects. So this is strictly anything that is being done under the ambit of CSR is strictly non-profit, and whatever the income or something that is being generated, if at all, during the process need to be reinvested in CSR projects, and companies cannot take that money from whatever investments or whatever activities they are doing, because sometimes some activities can generate income. So and in such cases they cannot take the money, and this is not an investment. Whatever things they do under CSR is not an investment, and there is no profit that companies can directly take. They could only reinvest that profit. So that's like, moving on, next question. This is a basic question. I think most of you will be able to answer it if you have a basic idea of treasury bills or government bonds in general. If the United States of America were to default on its debt, holders of the US treasury bonds will not be able to exercise their claims to receive the payment. Yeah. The US government debt is not backed by any hard assets, but only paid by the government. Yeah. This is not just the case of USA. Any country, this is the case. Because we say that government securities, treasury bills are gilt-edged, or gilt-edged meaning they are the top of the line quality assets or investments, meaning that they are backed by the government. That is entirely based on our trust on the government. There is no other thing backing that. That we are assuming that government will be able to pay that back if at all things go wrong. So that's the basic trust that we are having in the government. Nothing else is there. So that's the case in terms of treasury bills, in case of treasury bills of any country. That is why certain, the quality of treasury bills, government bonds varies from country to country, because not every country is having the same track record or level of trust in the eyes of public. So that is there. So USA, where to default on its debt, bondholders will not. Yeah, this is so true. In the case of financial crisis back then in 2008, similar thing happened. There was a bank run, and government was not able to manage it at first, but later they were able to recapitalize the banks and manage to do that. So this is basically the trust in the government. The same way, we trust our government securities and treasury bills. That's it. That's the basic thing. So this is the explanation for that and correct answer. And just a fun fact, even the cash note that we are having, if you have read the writings on that, it's basically saying that the holder of that, if I am holding a 100 rupee note, 100 rupee bill, it's basically saying that I am holding a bond, basically a government bond. So, that I am entitled to get a 100 rupee worth if I give that to the government. So that's basically our bank notes are basically a government bond, sort of a promissory note. So that's the basic idea. That's the same way demonetization happening, the entire thing goes out of value. It's basically on the trust on the government. The same way the bonds are, even our bank notes are also like that only. So moving on, next question. Consider the following statement in respect to digital rupee. Okay, it is a sovereign digital rupee. You might have heard about it. Don't confuse it with e-rupee. That's a different thing. So digital rupee is a central bank digital currency issued by the RBI. So it's a sovereign currency issued by that's the first question. RBI in alignment with its monetary policy. Yeah, this is the same thing. It holds the same. It's a basic rupee in a digital format. Okay, so that's true. It appears as a liability on RBI's balance sheet. Yeah, that's true, because banknotes are like I said, they are like bonds, so they appear like liability on balance sheet, because if we give that 100 rupee, we should be getting a service, or we should be settled by that value. So that appears like a liability. Every rupee that is been spent, or every note that is been printed, every note, coin, or that is been printed appears like a liability on RBI's balance sheet. It's not an asset, obviously, because they are giving that thing to the public, and public is actually entitled to get that value back from the RBI, basically like holding a bond. So it's a liability, obviously. It's not an asset. Don't think that RBI is printing money and those money are RBI's and it's an asset for RBI. No, it appears like liability only, because anybody who is holding that thing can ask the RBI to return that, RBI or banks to pay them the sum that is that they are holding. So that is there. It's a liability. True. Again, this is true. Then it is insured against inflation by its very design. It's basically banknote in digital format, and we know that none of the banknotes or anything is been insured against inflation, because how can anything as basic as banknote be insured against inflation. That's why we are having monetary policy committees, things like that, to manage inflation. So this is very improbable, very impractical. Okay, so this is not the case. This could be a case if it's linked to something, or if it's a cryptocurrency deriving value from gold or something. But that's not entirely the case. This is entirely a digital rupee, basically rupee in a digital format. So if the rupee is not insured against inflation, this won't be insured against inflation. So that's gone. It is freely convertible against commercial bank and money in cash. That's true. This is basic fact. This is digital rupee. So obviously it should be able to be converted into anything like normal money and cash. That should be there. So 1, 2 and 4. So that's the answer D. Just understand about central bank digital currencies. Most like China also has that, India also has that, and many other countries have that, and they are doing this to reduce the dependence on hard cash. Also, like I said, we can actually program things like similar question has been asked in 2023. So we can program conditions for direct benefit transfer, like when to spend this money, or the window within which this money needs to be spent. Things like that could be programmed into digital rupee. This is all the more relevant when it comes to transferring of funds within the government, lapsability of funds, things like that, or direct benefit transfer. If you are transferring money to the people, we could set a time frame within which it should be used, or time frame within which it could not be used, things like that. This question has been asked in 2023. So yesterday also we discussed a similar question about central bank digital currency. So again a derivation of that has been asked. So you can see a clear pattern. Most of these questions on economy especially are a continuation of the question that has been asked in 23, 22, 21. So there is a clear pattern. Same way you could predict the 2025, and a combination of these 5 years you could predict some questions, or actually expect some questions in 2026. That's why I'm saying again and again, these PYQs are the most important things you should be doing when it comes to prelims preparation. So that's basic. So the answer is D. Okay, moving on. In India, non-banking financial companies can access the liquidity adjustment facility window of the. Oh, this is slightly trickier side because this is factual. There has been a doubt regarding this, because whether NBFCs can access the LA facility. LA facility basically is accessible to the banks only, but NBFCs as primary dealers can actually access liquidity adjustment facility. This is a slight fact, and there was a confusion regarding this. So I won't be saying anything about that, because even myself was having a confusion regarding this, whether or not this was right. We needed to wait till the official key was released. So in India, foreign institutional investors can hold government securities. Obviously true. In India, stock exchanges can offer separate trading platform for debts. Yeah, I hope you understand that, because stock exchanges basically deal with equity, but they can have a separate trading platform for debt instruments also. So that's true. Then the answer is, I think it's 1, 2, 3. 42, I think it's C. Yeah, this was a confusing thing for me also, so I couldn't choose between them, because normally NBFCs are not under LA facility, only the primary dealers are. Primary dealers are a specific kind of NBFCs. So that was a slight confusing statement. So, but now you should be knowing that NBFCs can access the LA facility. This is obvious, I guess, G security, and this is also very straightforward. So 2 and 3 you could easily arrive at the answer. So you should be having a doubt between, even I was having a doubt between these two, and this was the answer officially given by UPSC. So C is the answer. Moving on. This was a question that's been asked, and this was slightly on the confusing side if you haven't heard about it. Okay, this is not a very common thing, or a very common operation or body or an instrument that you come across, but you need to be knowing few things about it. I have prepared some content on this matter. So collateral, borrowing and lending obligation. So even if you don't know anything, you could do few things, okay, to arrive at the answer. Just like always we can deconstruct. Okay, collateral, borrowing and lending obligation. So they are basically borrowing and lending. We need to know in which of the cases there is an element of borrowing and lending happening. Basically debt servicing happening. So debt servicing happens in 2 of these markets. Definitely there is nothing in stock market. Forex market also there is no borrowing or lending. But there is, in case of money market and bond market, in these two cases, there is an element of borrowing and lending happening. So if you could eliminate these two and can arrive at the 50-50. And in order to move forward, you need to be knowing that collateral borrowing and lending obligations of, okay. So where could this be happening? We are giving a collateral and collateral borrowing. This is something that you always hear in repo and standing deposit facility. That's one area where we come across this collateral borrowing. So standing deposit facility, repo operations, things like that, they are actually the money market operations. So if you could arrive at these 50-50 and if you could connect it to the repo and standing deposit facility keywords, you can actually arrive at the answer as money market. You need to be applying few combinations like borrowing, lending, and eliminating those two. Then you need to be like collateral borrowing, which is a thing in standing deposit facility. So you need to be knowing that, and you can arrive at the answer. Slightly on the trickier side, if you cannot apply such logic or if you cannot work on that, it's fine if you can leave it. But this is something you could do. Okay, you need to be thinking on these lines. So moving on, next question. No, I'll be explaining few things about this. Actually, you need to be knowing few things because a question can be asked. So we need to know what is collateral based lending obligation. It's like two banks. Okay, they're having one is having a deficit that is needing some money, say 100 crore or an overnight balance sheet coverage or something of that sort. An emergency 100 crore is needed, and they are having, obviously as a bank they will be having government securities as as part of their assets. So they could do what? They could actually use that government securities worth equal to or more than that money, and they could actually do get the money from another bank or institution through clearing corporation of India and actually cover their deposit, cover their needs. So it's like basically the clearing corporation of India acts like a middleman, and the borrower will be depositing the collateral with the clearing corporation, and clearing corporation will be advertising that okay, there is the somebody has requested for such money and they have given such collateral, so we approve of that collateral, saying that this is a valid case and the collateral is more than what they are asking for. So anybody willing to lend the money, obviously they will be getting the interest rate for that matter. But the whole thing is being operationalized and secured by Clearing Corporation of India, which is an official government body. But the participants need not be always public sector banks or anything. It could be private banks also. So within the financial institutions, by depositing collaterals, and these collaterals under CBLO are generally government securities. So these are like short term, overnight, just for one night to 14 days. Banks, mutual funds, insurance, anybody can be participating, private sector or public sector. Actually pay attention to this body, Clearing Corporation of India. That's like a settlement or a clearing house. They take the bonds. They're like the middleman connecting between two bodies, a borrower and a lender. So that's what Clearing Corporation does, and they will be using collaterals like government securities or any other things for that matter. But generally they'll be using government securities. But the thing is, CBLO is right now obsolete and it's now been replaced by tri-party repo. Basically, it's doing the same thing. Tri-party means there are three parties engaged, and repo means repurchase agreement. So it's the same functioning, but it's more automated. Like earlier, only government securities are being traded as collateral. Now other things could be traded, like cash management bill, state development bonds, things like that could be traded, and it's happening in a more automated fashion. And that's the basic idea. It's similar to CBL only, but it is being replaced by tri-party with more automation and more instruments other than government securities. So CBLO is now tri-party repo. Just remember that. Okay, have an idea about that also. Moving on, total fertility rate in an economy is defined as, I think you all know the answer. It's TFR. We have always been saying about TFR 2.2, replacement level, things like that. Number of children born per 1,000 people in population of year. Okay, even if you don't know, okay, we'll try to apply some logic. The number of children born per 1,000 people in population in a year. That's like basically birth rate. That's not the case. Number of children born to a couple in their lifetime in a given population. About a couple. Okay. Birth rate minus death rate. That's the actual population. There is nothing dealing with fertility. So this is gone. This is gone. then the average number of live births a woman would have by the end of her childbearing age. This is actually the answer, and this is, again, we can eliminate this seems very improbable, something not at all related or doesn't give any value about an economy thing. So we can actually arrive at the answer by eliminating also, but this is something you will be always knowing. So there should be, if you are not knowing, I'll explain it in slight detail, that TFR is like the total fertility rate, average number of children of women. That's the important thing, not average number of children in a population or anything. It's just women in her fertile age or in their lifetime. Like I think 18 to 45. That's the age they are prescribing. The number of live birth. Okay, that should be that's also there. A woman is having during her fertile age of 18 to 45. So if that number is greater than or equal to 2.1, meaning that the population, if it's equal to 2.1, the population will be sustained. For example, if 1 lakh is the population and the TFR is 2.1, then the population will remain like that for the next year or the coming years. If it goes down, meaning that TFR goes below this, there's a chance that population will be going down in the future. If it goes up, meaning that population will go up in the future. So that's called TFR. And a more elaborate or sophisticated way of calculating the replacement of population is like net replacement rate. That is average number of surviving daughters per woman. This is only children per woman. Now we are taking into account daughters because they are the ones, because the survival of women actually gives an idea about the fertility and the potential of population growth in the economy. So here in TFR only children is being taken into account, but in net replacement rate, surviving daughters, the girl child that is been born to a woman in her fertile age is taken into account. So in that case, the replacement value is 1. If net replacement rate is 1, the population will sustain or remain as it is. If it goes above 1, it will increase, below 1, decrease. So it depends on birth rate and female mortality. This is why, sex ratio becomes important, and female infanticide, things like that are taken into account, because this is a more holistic way of calculating the population growth, net replacement rate. But currently we are using TFR, and you will be knowing that TFR of Kerala and southern states are generally much lower compared to the northern states, and it is also an indicator of social development and population control, things like that. So just have an idea about that, TFR and net replacement rate. That's all. So I think you have got an idea about this 2024 question. So in the coming week, we'll be moving towards other subjects so that you can get similar ideas. And I really hope you are making the best out of this discussions that we are having. So try to stay cool and try to apply this logic, and don't try to mug up anything that I say. Even if something that I say doesn't fit your strategy, try to incorporate it, and if it still doesn't fit, leave it. Okay, I'm not enforcing, I'm not asking you to follow something that I say just because I said it. Okay, just don't do that. Just don't do that for anybody. Follow a strategy that works for you and that rewards you, and use test series to assess your performance. And I recommend you take our Gallant test, which has got a highest level of quality when it comes to the level of questions that is being set. This is we are having an oversight team, including myself and our greatest faculties that we are having. So I recommend you to take the Gallant test so as to stay in touch, in line with the actual examination demand and pattern. And just like always, if you have any queries, any doubts, reach out to me through Gallant IAS. So that's about it. Thank you.